Right now, while you're watching this, institutional AI systems are executing trades in microseconds. Your brokerage app processes your order in 10 to 100 milliseconds. That gap sounds like a technical footnote. It isn't. That gap is where your money goes. Latency arbitrage accounts for 33% of the effective spread on every single trade you make. Not occasionally. Every time you buy or sell, you're paying a hidden tax you never agreed to and can't see on any statement. Most people blame insider trading or corrupt brokers when their portfolio underperforms. The real mechanism is far more legal, far more sophisticated, and running at machine speed right now. But the same AI rotation patterns that bleed retail investors dry also leave a trail, and that trail is readable. In the next 14 minutes, you'll understand exactly how the machine works against you and the three-step system to flip it in your favor. Let's be clear about something. The speed gap between institutional AI and your brokerage app isn't a bug they forgot to fix. It's the business model. High-frequency trading firms have spent billions on co-location servers, microwave towers, and fiber routes specifically engineered to shave microseconds off execution time. Your order travels through a standard retail brokerage interface, gets routed, processed, and filled, all while their AI has already detected it's coming, repriced ahead of it, and handed you a worse fill. Legally, repeatedly, invisibly. You paid more than you should have, and nothing on your confirmation screen tells you that. This is how latency arbitrage actually works in practice. The AI doesn't need to know what you're buying. It just needs to see order flow entering the market and move faster than you can. By the time your buy order executes, the price has already shifted in the direction you were betting on, because the machine bet there first. Now here's a case that should make you question everything about internal oversight at these firms. 2 Sigma, one of the most sophisticated quantitative hedge funds on the planet, paid a $90 million SEC settlement after a single researcher modified live algorithmic trading models without proper oversight for 4 years. 4 years. The firm had entire risk and compliance departments, and nobody caught it. If internal controls at a firm like that can't detect a rogue actor manipulating live AI trading models, retail investors never had a prayer of knowing what was hitting them. And this isn't a fringe problem at a handful of firms. By 2025, 75% of UK financial firms were using AI in trading, up from 53% just 3 years earlier. This is already the water you're swimming in. The question was never whether AI would take over institutional trading. That already happened. So what's the regulatory backstop protecting you? The SEC's total fines for AI washing violations in 2024 came to $400,000 total. Bank of America's fine for Treasury market manipulation was $24 million. The enforcement gap doesn't lie. The system is calibrated to protect the players running it, not the retail investor on the other side of the trade. And the real cost isn't some abstract percentage point. Latency arbitrage accounts for 31% of all price impact on your trades. That's not basis points disappearing into thin air on a single transaction. That's a structural drag on every position you build, compounding against you over years. Think about what a consistent 31% drag on price impact does to a retirement account over 2 decades. It doesn't slightly underperform. It produces a fundamentally different outcome than the one you were working toward. The machine isn't going away, but it does leave tracks, and that's exactly what we're going to follow. So the machine bleeds you on every trade. But here's where the story flips. Because the same AI systems running those rotation plays aren't operating in a vacuum. They move money in patterns, and patterns leave evidence. What I'm calling wealth arbitrage isn't a product or a platform. It's a behavior. Institutions use AI to detect rotation signals, money shifting from one sector or market cap tier to another before the rest of the market prices that move in. They're not predicting the future. They're reading flows faster than you can, repositioning ahead of the crowd, and collecting the spread between where the market is and where it's going. That spread is the arbitrage. And for years, retail investors had no way to see it happening. Look at what played out from November 2025 through January 2026. The Russell 2000 surged 16%, while the Nasdaq gained only 8% over the same window. That's not a random divergence, that's a rotation. Money was moving out of large-cap tech and into domestic small caps, driven by Fed rate cuts making variable rate debt cheaper for smaller companies and stretched valuations finally cracking on the mega-cap side. Institutional AI modeled that shift weeks before retail money started chasing it. By the time the narrative hit financial media, the positioning was already done. The 2023 AI theme cycle showed the same mechanics at work on an even more compressed timeline. When AI hype peaked in large caps, Nvidia leading the charge, institutional flows started trickling into small cap AI names. Stocks like CXAI caught those flows and hit gains above 1,000% in under 2 days. The AI detected the pattern. Retail investors saw the headline after the move was already over. Why does this keep happening in small caps specifically? It comes down to coverage. Large cap stocks have dozens of analysts watching every earnings call and filing. Small caps are underfollowed, which creates information asymmetry, gaps between what's actually happening and what the broader market has priced in. AI tools find those gaps faster than any human analyst can. And because fewer people are watching, the inefficiency window stays open longer, which means there's more time to act once you spot it. The signal that ties this together is earnings acceleration. Tickeron's AI robot ran a scanning process across the Russell 2000 looking for stocks where liquidity, relative strength, and earnings momentum were all improving simultaneously. Not one of those factors, all three at once. That multi-condition filter generated 109% annualized returns. These weren't lucky picks. They were systematic signals being read by a machine trained to find exactly this pattern. The Fed rate cut tailwind added another layer. 75 basis points of cuts by late 2025 structurally favored small caps carrying variable rate debt because lower rates directly reduced their cost of capital. Institutional AI had that thesis modeled months before the cuts landed. The S&P Small Cap 600 is now projected to grow earnings at 21.2% in 2026 compared to 12% for the S&P 500. That gap didn't appear by accident. It appeared because institutional money was already there. The rotation signal is readable. The question is whether you know what you're looking for. Knowing the pattern exists doesn't put money in your account. Doing something with it does. So here's the three-step system, built on the same signals institutional AI uses, just accessed from the retail side. Step 1 is tracking the rotation signal, not the individual stock. Most retail investors start by hunting for a specific ticker, which is exactly backwards. The macro rotation happens first. Individual stocks move because of it, not before it. What you're watching is the relative strength between the Russell 2000 and the Nasdaq 100 on a weekly chart. When small caps start outperforming for 2 consecutive weeks after a sustained period of underperformance, that's not noise. That's the early signature of an institutional rotation already in motion. The AI didn't wait for week 2 to confirm, but you don't need to be first. You need to be early enough to still capture the bulk of the move, and 2 weeks of confirmation gets you there before the mainstream narrative forms. Step 3 is using ETFs as your first entry point, before you've finalized any individual names. IWM, which tracks the Russell 2000, and DES, which focuses on dividend-paying small caps, give you immediate exposure to the macro rotation while your stock-level screen is still running. You capture the index-level move first, then refine into individual positions as your criteria confirm. This sequencing matters because the rotation itself is the primary trade. Individual stock selection is how you amplify it. Risk management isn't optional here. Equal-weighted positions across your selected names, with trailing stops tied to 65-day moving averages, is the structure Tickeron's AI robot uses specifically to survive the volatility that comes with small-cap momentum plays. The same conditions that create the arbitrage opportunity, thin coverage, fast-moving flows, compressed timelines, can also obliterate an unprotected position if the rotation reverses. Trailing stops don't cap your upside. They just make sure a single bad trade can't erase everything the system built. One more thing on the legal reality of this approach. Everything here runs on publicly available data and standard technical signals. Monitoring relative strength between two indexes is not front-running. Screening for earnings acceleration is not insider trading. You're doing pattern recognition on the same information institutions use, just with a slight time lag. That lag is real, but it's compressible. Knowing what signal to watch before it shows up on CNBC is most of the edge, and that's the mistake that kills most retail attempts at this. They wait for the story. By the time a rotation makes the financial news cycle, institutional AI has already built its position and started planning the exit. The signal you're watching is the divergence on the chart, not the analyst on television explaining why it happened. Let's make this concrete. Two investors, same starting capital, same time horizon. The only difference is what they do with the information in this video. Investor A ignores it. They keep routing orders through a standard retail brokerage, paying the latency arbitrage tax on every transaction. The Russell 2000 versus Nasdaq 100 divergence signal appears in early 2026, and they don't recognize it, so they don't act on it. The small cap rotation runs its course. In 2027, they're looking at a portfolio that underperformed the Russell 2000 by double digits and trying to figure out why their index fund strategy didn't work the way the books said it would. Investor B sees the 2-week confirmation signal, allocates to IWM before the mainstream narrative catches up, then runs the 3-condition screen and moves into individual small cap names meeting all the criteria. They participate in the 21.2% projected earnings growth for small caps instead of watching it from the sidelines. They're not day trading, they're not competing with HFT firms on execution speed. They're reading the same macro rotation signals institutional AI uses, one step behind the machine but still well ahead of the crowd. Here's the compounding reality that makes this worth understanding at a deep level. A 9% annual return difference between these two investors, held consistently over 20 years, doesn't produce a slightly better retirement. It produces a fundamentally different financial life. We're talking about the difference between financial flexibility and financial constraint at the exact moment in life when it matters most. This strategy isn't about speed. It's about signal literacy. Knowing which data to watch and when a shift is actually happening versus when it's just market noise. Institutional AI isn't cheating. It's reading signals faster, and now you know which signals to read. Pull up a Russell 2000 versus Nasdaq 100 comparison chart today and look at the last 90 days. The rotation signal is either there or it isn't. And that answer tells you exactly where institutional money is positioned right now. Part 2 goes deeper into the individual small cap screening criteria and how to size positions without getting blown up by volatility. If this changed how you think about who's actually on the other side of your trades, subscribe, because that's where the real edge gets built.